In the last 6 weeks, leaders in Washington, London, Paris, Berlin, Tokyo, and Canberra have told their citizens the same thing. Prepare. Prepare for higher fuel. Prepare for higher food. Prepare for a global recession that, according to the International Monetary Fund, the world may not be able to avoid. On April 14th, the IMF cut its global growth forecast and warned that a longer war could push the world to the brink of recession. On May 12th, the U.S. Consumer Price Index hit 3.8%, the highest level in nearly 3 years. Brent crude is trading above $100 a barrel and rising. Gold has crossed $4,700 an ounce. And the Strait of Hormuz, the 33-mile artery that carries 1/5 of the world's oil, is still effectively closed. The war between the United States and Iran is over in the headlines. The bill is now due, and everyone, from a pensioner in Manchester to a family in Phoenix, is paying it. Start with the number that matters most. On February 28th, the day the war began, Brent crude was trading near $80 a barrel. By early May, it had surged to $114, a 43% jump in just over 2 months. Even after a brief ceasefire eased the panic, prices remain above $100 with no clear path back to normal. The reason is the Strait of Hormuz. Roughly 20% of the world's oil, and a similar share of its liquefied natural gas, passes through this single waterway every single day. According to the International Maritime Organization, up to 20,000 seafarers are still stranded on 2,000 ships inside the strait. Saudi Aramco's CEO has warned that the market is losing about 100 million barrels of supply every week. That is not a price spike. That is a structural break. In 1973, an oil embargo tripled prices and triggered a global recession. In 1979, the Iranian Revolution did it again. Energy shocks of this size have produced recessions every time they have happened in the modern era. Goldman Sachs estimates global oil stocks could fall to just 98 days of demand by the end of this month. Refined products, diesel, jet fuel, naphtha, are draining even faster. The world is not running out of oil. It is running out of the oil it can actually move. When investors lose faith in paper, they buy metal. That is the oldest rule in finance, and in 2026, they are buying like the world depends on it. Gold hit an all-time high of $5,589 an ounce in January. Silver crossed $100 an ounce for the first time in history. Even after a correction, gold is trading near $4,700, up more than 50% in a single year. Behind the rally is something more important than retail speculation. It is central banks. According to the World Gold Council, central banks bought 244 tons of gold in just the first quarter of 2026, a 3% increase year over year, even at record prices. Poland is leading the charge, accumulating toward a 700-ton target. China has added gold reserves for 18 consecutive months. In 2025 alone, central banks bought 863 tons of gold, the largest annual addition since 1967. This is what de-dollarization looks like. After Western governments froze $300 billion of Russian central bank assets in 2022, every other central bank in the world learned the same lesson. Dollars in a Western bank are political assets. Gold in your own vault is not. When the world stops trusting paper money during a war economy, it returns to metal. It has always returned to metal. Here is how an oil shock becomes a household crisis. In April, U.S. energy prices rose 3.8% in a single month and 17.9% year over year. Gasoline alone is up 28% from a year ago. The national average is now $4.50 a gallon. Airline fares up 20.7%. Grocery prices up 3.6% and climbing as diesel fuel costs ripple through the trucking industry. And here is the part nobody warns you about. Real average hourly wages just fell 0.3% year over year. For the first time since 2023, Americans are working harder for less. This puts the Federal Reserve in an impossible position. To fight inflation, it must keep interest rates high. But high rates strangle housing, credit cards, small business loans, and corporate borrowing. To support the economy, it would need to cut rates. But cutting rates while energy prices are exploding would pour gasoline on the inflation fire. Bank of America now expects no rate cuts until the second half of 2027. The European Central Bank faces an even worse version of the same trap because Europe imports almost everything. Economists have started using a word that hasn't seriously been deployed since the 1970s: stagflation. Inflation rising, growth falling, and no monetary tool that fixes both at once. Every war has its winners. They are rarely the people doing the fighting. On March 2nd, the first trading day after U.S. and Israeli strikes on Iran, defense stocks rocketed. RTX, the maker of Tomahawk and Patriot missiles, jumped 4.7% in a single session. Lockheed Martin, maker of the THAAD interceptors and the F-35, rose 3.4%. Northrop Grumman climbed 4 to 6%, depending on the index. All three hit 52-week highs. In the 3 years from March 2023 to March 2026, RTX's stock has risen 110%. Northrop is up 60%. General Dynamics is up 57%. In the first quarter of 2026 alone, RTX reported $22.1 billion in sales, up nearly 9% year over year. Its backlog of orders reached $271 billion, one of the largest in the company's history. The Trump administration has signaled a Pentagon budget of $1.5 trillion by 2027. That is more than the next 9 countries combined spend on their militaries. Then there are the oil and gas companies. U.S. crude and petroleum exports hit nearly 12.9 million barrels a day in April 2026. A record. When the Strait of Hormuz closes, American shale becomes the world's substitute supply. And every dollar that gasoline climbs at your pump is a dollar that flows somewhere. Hedge funds positioned long on oil and commodities are reporting their best quarter in over a decade. Gold dealers are reporting their highest physical demand since 1980. Major investment funds like BlackRock and State Street, which together own more than 20% of Lockheed Martin's stock, are watching their portfolios swell. This is not a conspiracy. It is arithmetic. A war happens. Some balance sheets bleed. Others bloom. Now, look at who is on the other side of those balance sheets. In the United Kingdom, drivers are paying the equivalent of nearly $8 per U.S. gallon. In Germany, household energy bills have climbed for the third consecutive quarter. In the Philippines, which imports 98% of its oil, the government declared a national energy emergency in March. Japan has released 80 million barrels from its strategic reserve, 15 days of national demand, just to keep the lights on. Australia cut its fuel excise by 50%. In Myanmar and Nepal, citizens are being rationed. Inside the United States, the picture is quieter, but no less real. The average American family is now spending an extra $1,400 a year on fuel alone, according to Troundry A price tracking. Grocery bills are up an estimated 15% in the metro markets hit hardest by diesel costs. Mortgage rates remain elevated because the Fed cannot cut, and Americans on fixed incomes, pensioners, retirees, anyone whose paycheck does not rise with prices, are watching the real value of their savings erode in real time. The hardest hit are not in the West at all. Emerging markets are being crushed by a perfect storm. A strong dollar makes their debt more expensive. An oil shock makes their fuel more expensive, and a global slowdown makes their exports cheaper. The IMF has cut Iran's own growth forecast by more than 7 percentage points. In the Middle East and Central Asia, projected 2026 growth has collapsed to 1.9%. This is the asymmetry of war economics. The gains concentrate at the top. The costs distribute to everyone else. The IMF's base case for 2026, assuming a short war, is now 3.1% global growth, down from the 3.3% expected in January. Their longer conflict scenario is 2.5%. Their worst-case scenario is 2%, which the IMF itself describes as a close call for a global recession. In that scenario, oil averages $110 a barrel this year and $125 next year. This recession, if it arrives, will not look like 2008. The 2008 crisis was a demand collapse. This one is a supply shock. That distinction matters more than most people realize. In a demand collapse, central banks cut rates, and the economy slowly recovers. In a supply shock, cutting rates makes inflation worse and recovery slower. The closest historical parallel is the 1970s, when stagflation lasted nearly a decade. It took the U.S. raising interest rates above 19% under Paul Volcker to finally break it. That kind of medicine destroyed millions of jobs along the way. The honest answer about timing is this: if the Strait of Hormuz reopens fully within months, the world may absorb the shock with a shallow recession and elevated inflation through 2027. If it does not, the analogs stretch back further, to a decade of slow growth, persistent inflation, and falling real wages. Either way, the next 12 to 24 months will be defined not by what happens on a battlefield, but by what happens at the pump, in the supermarket, and in the boardrooms of the central banks. There is a pattern in human history. Wars end on paper long before they end in economies. The 1973 oil embargo lasted 6 months. The recession it triggered lasted years. The inflation it unleashed reshaped politics for a generation. The Iran war is over in headlines. Its economic aftershocks will reshape the global economy for the next decade. The people who decided to start it will not pay the price. The people who had no say in it will. That is the oldest pattern in human history. And in 2026, it is happening again. If this video taught you something, subscribe. Because the story of how this decade reshapes your money is just beginning.